understand various types of products in trade finance. Let's take an example. You are Ramesh, an Indian exporter of textile garments. You've just received a huge order from Carlos, an importer in Brazil. Both of you are excited. The deal looks promising. But here's the catch. While Ramesh wants guaranteed payment upfront, Carlos wants the goods delivered before he pays. This tug-of-war between trust and risk is where trade finance steps in. Now let's follow Ramesh, Carlos and their banker Meera through different trade finance options, each designed to solve their problem in a unique way. Cash in advance. Meera the banker tells Ramesh, if you want absolute safety, ask Carlos to pay before you even ship. This is cash in advance. Great for Ramesh because his risk disappears. He gets money upfront. But Carlos frowns. Why would he pay without seeing goods? This method heavily favors exporters but strains relationships if buyers don't trust easily. Buyer's credit. Carlos then asks, what if I borrow the amount needed to pay you from a bank? This is buyer's credit. A bank lends Carlos the funds, so he pays Ramesh on time while repaying the loan later. Credit risk now shifts from Ramesh to the bank. Supplier's credit. Ramesh also has another option. What if I ship the goods now and Carlos repays me later with interest? That's supplier's credit. Here Ramesh takes the risk but can safeguard himself with insurance or guarantees. It keeps Carlos happy with extended payment terms but puts more pressure on Ramesh's cash flow. It is often used in letter of credit transactions. Letters of credit, LCs. Meera the banker then steps in. Why don't I guarantee the deal? With a letter of credit, Ramesh ships the goods only after knowing the bank will pay once documents prove shipment. Carlos feels safe. He only pays once conditions are met. Ramesh feels safe because he's relying on a bank, not just Carlos's promise. This is the most trusted middle path in global trade. Documentary collection. If both want less cost than an LC, Meera suggests a documentary collection. Here Ramesh gives shipping documents to his bank which passes them to Carlos's bank. Carlos can only collect the documents and thus the goods if he pays or accepts a bill for later payment. It's cheaper than an LC but riskier for exporters. Factoring and forfeiting. Ramesh's working capital is stuck in invoices, so Meera introduces him to factoring, selling his receivables to a finance company at a discount. Now he gets cash up front and the factor takes the collection risk. For longer-term deals, forfeiting works similarly but applies to medium or long-term receivables. Both give exporters liquidity and peace of mind. Open account. Now imagine Carlos as a powerful buyer. He says, in Brazil, everyone gives open account terms. Ship first, I'll pay in 90 days. This is open account trade. Great for the importer but risky for Ramesh. If he agrees, he might lose sleep unless he uses export credit insurance or receivables discounting to cover potential defaults. Receivables discounting. Finally, suppose Ramesh wants quick liquidity. He sells his invoices to a financial institution at a discount. This receivables discounting helps him get immediate cash, though often at a higher cost. SMEs frequently rely on this when waiting periods are long. By the end of the journey, Ramesh realizes something important. As an exporter, his main fear is not getting paid. As an importer, Carlos's main fear is not receiving goods as promised. And Meera, the banker, is the bridge, providing trade finance products that balance trust with risk. Every product, from cash advances to receivables discounting, is just a different story in solving the same problem, bridging the gap of trust between buyers and sellers across borders. Trade finance in essence is not just about money, but it's about trust, timing, and making global business possible. Thanks for watching the video. Don't forget to share and subscribe to view more such insightful videos on interesting facts and regular updates on trade finance.